Our next session will feature Mr. Piyush Gupta, Group CEO of DBS, joining us from Singapore. Good morning, Piyush.
Hi, Casey. How are you doing? Good to see you again.
Great. Many thanks for taking the time out of your busy schedule to share your insights with us. And I'm sorry for the delay because of a bit of overrun in the previous session.
I noticed, Casey, that this morning's agenda, I suspect the only reason I'm invited is because of my long years with Citibank, 27. Because I noticed there seems to be a Citibank morning.
Well, I'm not so sure you realize, Piyush, there was a time in Hong Kong when Citi was considered the Shaolin Temple of banking in Hong Kong. I'm not so sure whether
that is true for
today.
all over Asia. It is true for all over Asia, Casey.
Yeah,
so
today is DBS. Today is DBS.
You're too kind.
Well, anyway, just for the sake of our audience, I just want to say a little bit about Piyush. Piyush has been the CEO and director of DBS Group since 2009. And well, I had the privilege of working with Piyush for about 9 years when I was a member of the DBS Hong Kong board. So that's also a declaration of interest. I'm very impressed by Piyush's sharp and insightful analysis of many issues and his strategic focus on what matters most for the long term. He has a very incisive perspective to different issues from a global and macro perspective. And he also has a very keen interest in going through the details of the important subjects. So both the macro and the micro level, he is a great leader. I've watched personally how Piyush started to focus on fintech and digitalization for DBS many years ago, when these technical terms were merely talked about very generally by most people. I still remember the conversation we had some years ago when Piyush said that computer and digital skills are a core competency of the bank. That was the time when dominant thinking amongst most banks and companies was to contract out their various IT needs to specialist vendors. So let's start, Piyush, by asking you to tell us some of your insights on digitalization and fintech. DBS has been named the world's best digital bank by Euromoney. What prompted DBS to take its first steps in its digitalization journey? And what has been the most challenging part of this journey?
So, Casey, thanks again. Thanks for the kind words. Let me actually, to answer that question, we need to go back in time. In 2012, we were trying to acquire a bank in Indonesia. And the reason we chose Indonesia is because neither China nor India, the other countries we were interested in, would allow M&A. As things happened, the Indonesians changed the rules in the middle of the transactions as well. And it became quite clear to me, therefore, that the traditional path to growth was going to be somewhat stymied. Around the same time, I happened to have a conversation with Jack Ma. And in that conversation, it became quite clear to me that what he was trying to do with Alipay at that time, when she became Ant, would be a game changer for our industry. Because Alibaba was trying to think about acquiring hundreds of millions of customers with no branches, no feet on street, and using data effectively. You also started looking around. That is about the time, 2012, 2013, when you started seeing the unbundling of the banking value chain. So whether it was in the space of payments or remittances or wealth management, you could see a lot of startups beginning to make their appearance. So we took heart and we said, if you're going to win in the world of tomorrow, we might need to fundamentally revisit and rethink our strategy. Now, I was somewhat blessed that because in my previous life at Citibank, I'd done a lot of work with e-commerce and internet and intranet, and I'd actually set up a .com as well in the year 2000. So I had some natural proclivity and inclination towards the subject. But we spent 6 months through the late part of 2013 and 2014 with my CIO going around the world, meeting up with most of the big tech firms, Amazon, LinkedIn, Netflix, Facebook, etc. And he brought back some insights which were really quite revolutionary in my mind. We started calling that the big tech model. And there were 4 or 5 big ideas. Number one, customer acquisition. it is quite clear that the technology companies acquire customers totally online. They have no branches, they have no physical presence. This allows them to lower the cost of customer acquisition and allows them much greater distribution power. Second, that these technology companies that changed the bar, raised the bar for customer expectation in terms of transacting. Everybody got used to the idea of instant transacting. You type something in Google, you get a response right away. Whereas in the banks, our whole paradigm for execution was 24-hour turnaround or morning, evening turnaround. So we realized that to be able to do that, you have to kill paper and get completely seamlessly straight through. But that was the second big difference. A third difference we found was that we were in our industry used to this idea of cross-sell, where you acquire a customer to maximize the lifetime value of a customer, you push more and more product. Well, the tech-fin industry had gone out of the product pushing game and instead got to a situation where they could use the customer context and customer insights to create a situation where the customer voluntarily chose to do more and more with you. I call it a migration from cross-sell to cross-buy. And that is a big difference in the way they operated. And then we realized fundamentally that these companies, they're big users of ecosystems, partnerships, something banks don't do. And finally, they master data at a level that banks have never been able to do. And it then seemed to us overall that if we could take these 4 or 5 big ideas and put them into the heart of our banking business, we could reimagine banking that would allow us to differentiate ourselves from many other players. So I guess a long answer to your question of what kicked us off and what started us down this journey. Now, the second part of your question is, what's the hardest? I think people will tell you, all the literature tells you this, and I would tend to agree with it. The hardest is always the culture change agenda. And very early, we had a choice. Conventional wisdom at that time, all the HBRs, etc., said that it is very hard for old companies like ours to change. We're dinosaurs. And the people who win will always be young companies, young kids who work out of a garage or something. We took a counter-intuitive view. We said, the only way this is going to work is if we make everybody part of the journey. And so we came up with the shorthand for it saying 20,000 people startup. We wanted everybody to feel they were part of a startup. But how do you convert a company like ours with people of all age profiles and all groups to all thinking and believing that they are a startup culture? That's not easy to do, but we took a bet. We took a bet that people innately and intrinsically want to change. You can see that in the fact that we're all changing in our personal lives. Our mobile phones today allow us to do things so differently from the way we used to 10 years ago. We took comfort in the fact that older people, 50, 60, 70, are also able to make this change in their personal life. And we then boiled it down to 2 things that are different in the work environment, which come in the way. The first is the capacity to experiment, because adults learn by doing. So you've got to give them an opportunity to get their hands dirty. And second is the willingness to take some risk. People are worried about being scolded or losing the job or losing the bonus when they're in a banking environment. You've got to take that fear away. So if you can do these couple of things, do adult learning by doing, give people a chance to experiment, take away the fear of failure, then you pretty much get similar kind of outcomes. And so that journey has been extraordinarily rewarding for us. It has been hard. It has been the hardest thing we've done. I wouldn't lie. I don't think we still have 100% of the people on the bandwagon, but I think we have 80%, and that's quite substantive. But that has been the hardest part of the journey. If I had to mention one other thing, Casey, is obviously data. I think data is not easy to get your hands around. It's crucial. It's the raw material for AI, it's the more raw material for machine learning. But to get your hands around data is a multi-year journey, because data is typically unclean, it's disorganized, and so that's some fairly heavy lifting as well.
Well, that's great. Thank you. Now, my next question perhaps is, well, digitalization efforts are great, but that requires sizable investments. How did you convince your board and shareholders to support you on those initiatives?
So, Casey, actually, let me tell you one state secret. Digitalization efforts require investment, and they require you to be kick-started, but the investments are typically not as large as people would like to believe. So even as late as 2013, 2014, our technology bill was already about just shy of $1 billion a year, call it $900 million. And we were spending money on a whole bunch of technology upgrades, the core banking platforms, the product processing systems, the large data centers we had. All of those were already taking money. One thing that we learned very early is that if you can revolutionize the technology and move to cloud native and the new stack technology, your costs come down quite sharply. And the cost of data center come down, the cost of using legacy core banking platforms come down, the cost of licensing from people like Oracle come down, and you can replace these with servers, you can replace these with outsourced providers for cloud, you can replace these with open source applications, so you can actually drive down the cost very quickly. So the real question then is, do you get quick paybacks and can you manage it? You can. The real question is, how do you get kickstarted? And that's where it's really important to have commitment and faith from the top of the house. So in late 2013, I took our board, our main board, to Korea for our annual strategy offsite. And in that board meeting, I remember presenting to them my vision for what a digital transformation would be, what it would look like. And then I presented my 2014 annual financial plans. At the end of the meeting, the board asked me, so if you can do all this next year, can you start catching up with Alibaba? And I said, no, I can't, because Alibaba basically is in a different league. They spend a lot more money, and it's going to take us a long, long time. So the board did something which was, to my mind, a tremendous signal of faith. They said, okay, all of this is very good. Your financial plan is fine. We approve it. But on top of that, you take $200 million more. And you just spend this money over the next 3 years. And we're pretty confident that you guys know what you're doing. Management is quite competent. Some good will come of it. But we will not ask you upfront for a bottom line impact statement. Now, 200 million on a 900 or $1 billion bill over 3 years is like a 6-7% growth. So it's not dramatic. But the signaling is dramatic. The signaling that the board in the top of the house are willing to put money behind the effort and willing to take some risk in this direction purely based on a leap of faith. That signaling turned out to be extremely, extremely important. Over time, now this is 7-8 years later, our 900 million bill has grown to, call it 1.1, 1.2 billion. So it's not dramatically different. However, the mix and the way we spend the money has changed a lot. In the early days, more than half of our spend used to go in what I call keeping the lights on, the business as usual activity of technology. And only a couple of $100 million went on doing new stuff, new activities, the pure digital agenda. Today, that ratio is very, very different. Today, almost 60% of our expenditure goes on the new stuff because we've been able to shrink the cost of the business as usual so dramatically.
Well, that's very interesting. Improving, investing in digital infrastructure and in improving efficiencies and so on are, of course, are important. But then, looking at the bigger picture, fintechs and digital banks are increasingly encroaching into the traditional banks' businesses. What's your view on this? How is DBS reacting to this?
So, Casey, I think the real idea is not thinking about who the player is, whether it's a fintech or a traditional bank or a technology company. I think the right question to ask is who is able to create a differentiated customer experience. And if you can create a differentiated customer experience, then customers will win. Because even if you look at, quote unquote, the fintech universe, the techfin universe, and you look at that in any industry, whether it's the search industry, Google was not the first search engine. Google was the 17th search engine. The first 16 eventually died because Google came up with a fantastic customer experience. So it wasn't just the old libraries which were impacted, it was even other techfins which got impacted. Similarly, in every industry, you can find the company which comes up with the best customer experience really tends to do extremely well. That doesn't mean that incumbents cannot come up with the same kind of customer experience. Frankly, today, technology is available to everybody. I just finished mentioning it in response to your previous question. We are able to get as much technology as any of the techfins can. It's all open source. It's all freely available. You need to plug and put it together. So today, our technology stack is as good as any techfin company's technology stack. We've actually, as you referred to in the introduction, we went a step further. Today, we employ 9,000 engineers in the bank, which is double the number of bankers we employ. So I can get the engineers, I can get the technology stack. The question is, can I create the same kind of customer experience as the technology companies can? And again, the data is illuminating in every industry where TechFin has gone in, because obviously, clearly, we are not the only industry where software is coming in. But in every industry, the incumbents who are being able to hold their own. You look at the story of Walmart. You would imagine that because Amazon came in and all the online shoppers came in, Walmart should be toast, but Walmart is not toast. Because Walmart was able to adapt the business model and be able to create a differentiated customer experience as well. And this is true in many other technology industries. So I think the same is true in our service, in our space. That if you can create a differentiated, competitive, and unique customer experience, you can still win. The second comment I want to make is even in this technology world, the cost of customer acquisition tends to be extraordinarily high. So for every 100 companies in the fintech who want to get into the financial services space, 99 will fail. And they will fail because they do not have the deep pockets and they do not have the capacity to acquire customers. So these 99, when I say they fail in a direct B2C sense. Many of them will succeed because they will wind up becoming partners with banks like us. They will become collaborators. We can use their products. We can package their products. We'll take their products out to our customer base. The 1% who generally succeed are people who already have a large ecosystem of customers, like Alibaba or WeBank. If you already have 1 billion customers, then your cost of customer acquisition is no longer a challenge. You can acquire customers easily. So you will find the big companies, the TechFins, the Googles, the Amazons, Alibaba, the WeBanks have a disproportionate advantage in that regard. But like I said, despite that, there is no certainty that incumbent banks have to lose, because incumbent banks can also compete on the same platform. Frankly, incumbent banks also bring something different to the party. One, we do have a lot of insights and knowledge of managing risk through cycle. A lot of the business models are good in good times, the algo models, sometimes they fail. So you need to be able to understand, how to manage risk through cycle. In the last crisis in the US, for example, many of the P2P companies found that delinquencies and cost of credit went completely haywire well over their models. That intuition is not always there. Second, banks often have the advantage of being a part of the clearing and settlement system and the plumbing. And so many of the tech firms actually come back to us for participating in the clearing and settlement system. You need to be careful that you don't go the way of telcos and become the dumb pipes, that you can still control some of the customer value in that process. Third, banks like us can also continue not only to create customer experience, but continue to be innovative. If you look at in Singapore, the Singapore banks, including ourselves, have a full suite of digital applications, whether it's the payment space, whether it's the cross-border remittance space, whether it's the wealth management space, whether it's the retirement planning space, whether it's the SME financing space. We offer almost everything that any of the tech fins can. And therefore, the competitive space to differentiate for a newcomer is not that large. I mean, of course, you can do it, but it's not that large. And finally, I think there is one last thing which you can write on, which is, for several years, especially in China, many of the tech firms benefited from regulatory arbitrage. We were subject to things like capital, liquidity, entity level supervision, etc. But many of the tech firms were not. I think in the last couple of years, that playing field has begun to level somewhat, where in many countries, regulators are beginning to put some kinds of guardrails to ensure systemic stability and to ensure level playing fields. And you're seeing that not just in China, you're seeing that in many other parts of the world. So you get a more level playing environment. I think that's also somewhat helpful to the banking system. Having said all that, let me just say one thing. I'm always wary of competition. I'm like Andy Grove once said from Intel, only the paranoid succeed. So any new competition is concerning. We focus very hard. We try to figure where we have strengths. We try to figure what tools we can use. And we try to figure how we can block and tackle every day in the marketplace. So it's not easy. However, I continue to believe that it is not impossible, that incumbent banks will respond quickly and respond intelligently, will continue to be part of the banking landscape even in the longer term.
Well, that's interesting. Well, we could talk more about that later on, but before we go to specific subjects, I want to also get your take on what your thinkings are about some of the digital trends that have been accelerated because of COVID-19. And what are some of the longer term digital trends that you think will shape the future of finance?
So, Casey, I guess the two obvious trends that got dramatically accelerated in the last 18 months are known to everybody. One is on the consumption side, where the digital consumption of everything has gone up exponentially. People call it 5x, 7x, 10x, but that's true in several industries, by the way. You take education, EdTech took off, and people basically didn't have a choice. You had to sit at home and study from home. Similarly, in medicine, a lot of people got used to the idea of doing teleconsult with doctors, not something that was easily imagined or envisaged in the past. And even just pure basic e-commerce, people started taking to that in spades. We saw that in our industry as well. It is quite interesting that in the course of the pandemic, the fastest growing populations which were using mobile banking and internet banking were actually the people over 60 years of age and the people like migrant labor or the people who traditionally had not used mobile banking. And they just told you that when things get bad, digital consumption takes up. Even those parts of the population which have been slow to adopt actually change, and they start adopting very, very quickly. In our case, our people over 60 who took mobile banking went up by 4x. And our migrant workers in Singapore, the total values and volumes of accounts quadrupled, and the total monies they started transferring using the platform to Indonesia, Bangladesh, and the country they came from also quadrupled. So it was quite dramatic, the consumption side of the story. By the way, the digital consumption expanded not just to consumers, but also to small and medium enterprises and large companies. We saw a lot of SMEs who traditionally had dealt in the cash economy also convert to accepting digital forms of payment, and therefore their own interaction with the banks started changing a lot. Second, a big change, which obviously happened at the large corporate end, linked to the consumption side still, is a rethinking of the nature of supply chains. And here I'm not talking about the fact that people got worried about China and China plus one, etc. I'm talking about the fact that people suddenly realized that the supply chains were not transparent, and therefore they did not have line of sight to the supplier, and the supplier. As you went down the supply chain, they found they did not know where the bottlenecks were. So a lot of large companies, and frankly even industries and governments, have started focusing on digitizing the supply chains entirely. And that creates an opportunity for providers like us to be able to take and plug in. We offer almost 600 APIs to be able to do all kinds of things. So one of the biggest growths in our business in the last year has been to digitize supply chains and go and embed ourselves into the supply chains of many platforms, companies, industries, etc. has been quite rewarding. The second big shift is quite clear, is this whole idea of working from home. We've all spent a year and a half working from home. And if you look at the world pre-COVID, maybe 2, 3, 5, if you're lucky, percent of the population could really work remote. It was a function both of the technology. In many cases, the VPNs and VDN, etc., were not there. It was a function, however, mostly of mindsets. Companies are not prepared to take the risk of having people go and work from remote locations. Well, the COVID changed all that. And therefore, most companies I know took 2, 4, 6 weeks to get the technology act together. In our case, it took us less than 24 hours because we were well equipped. But more important, companies also changed their risk appetite and their risk parameters. How do you box in what company, what people, how do you protect, people working from outside the office environment? How do you take care of cybersecurity issues? How do you take care of data privacy issues? How do you actually put safeguards, which are compensating safeguards? Certainly in our case, we figured all these things out very quickly. And that meant that we've been able to run the last 18 months with people working from home. In India, for example, where we have 4,000 technology operators, all 4,000 work from home and have been doing that for a year. And so that's actually a very profound shift. As you know, Casey, there's been a lot of debate in the last year or two about the death of globalization and people sort of going back to supply chain shrinking and people onshoring or nearshoring. I have a contrarian view. I think one of the outcomes of this pandemic is really going to be a massive acceleration in a form of globalization, and that will be globalization of the workforce. People have begun to realize that, if you can go and work from home, then you could be sitting anywhere in the world and you could work from anywhere. So I think you will start seeing a lot more democratization and globalization of the workforce as an important part of this trend. Looking outside of the pickup in digital, there are a couple of things that really have accelerated in the last year. One is data and AI. I think when you're dealing with customers remotely and you're dealing from a distance, when you got to do all of this surveillance, when you got to give customers ideas, you got to do risk management, people begin to recognize the power of data and AI. And certainly in our case, artificial intelligence and machine learning has taken a massive uptick in the last 12, 18 months. It's in our marketing, it's in our risk management, it's in our AML, KYC, it's in our onboarding systems, it's in our human resource, it's in our employee recruitment, it's across the board. And so that's taken a huge lift in the course of this period. Another area which has also taken a good lift, Vanessa was talking about it when I just dived in, is the idea of distributed ledger and blockchain. I think that has less to do with the pandemic per se, other than the supply chain side. It is just to do with the fact that I think it's a technology whose time has come. And the time has come principally because for some of these technologies to work, you need to get tipping point in terms of exponential usage. When enough people start believing in a protocol, enough people start coming to the party, you start getting takeoff. So in the last year, you're getting both. You're getting some takeoff in things like cryptos and the use of different kinds of cryptos. Some of these are the meme stock kind. But you're also seeing takeoff in more private wall blockchain solutions. And so you're seeing better solutions and well-architected solutions for trade finance. You're seeing better solutions, again, in end-to-end supply chain management. And you're beginning to see a greater interest in the currency end of the solution as well, both central bank digital currencies as well as other currencies. We ourselves at DBS in the last few months have launched a couple of things. We launched a digital exchange, which allows people to effectively issue, tokenize any kind of asset, property, financial assets, etc. It's a listing platform. We hope to be able to even to list illiquid Series B, Series C kind of stock. Then it's an exchange where you can actually trade the crypto assets. So today we're trading 4 crypto coins on that exchange already. And it's a digital custody offering where you can take your crypto keys and make sure you get custodized with the safety and security of a bank. So we've created a whole offering around that. We've launched another one called Party, or it's a technology company in the joint venture with JP Morgan and Thematic, which is to see how we can take effectively tokenized fiat money and use that as a basis to change the international clearing and settlement system. And so we're seeing a lot of interest from different banks to be partners in this. We think we can kill the T+2 paradigm in cross-border payments. We also launched another thing in partnership with a couple of people, Standard Chartered, Temasek, and the Stock Exchange, which is to do with creating a carbon exchange, where eventually we hope to tokenize the carbon credits and use blockchain technology to be able to create a marketplace in those as well. So I think all of these technologies have been game-changing. As you go forward, I tell you the one thing which I think you will see a lot of in the next couple of years, I think 5G is rolling out at scale in many of our countries. And 5G, just because of the bandwidth that becomes available, allows you to create even more refined customer experiences, whether it's the Internet of Things or just smarter ways for being able to engage with machines. I think there's going to lead to a lot of change in the service capability of many companies and industries as well.
Well, that's interesting. You have covered quite a lot of subjects. But I think let's deal with some of the more important subjects one at a time. Well, first of all, I think you mentioned earlier on your investment in upgrading the core banking system in DBS. You decommissioned the old core banking system running on the mainframe and to build an API-based microservices system running on the cloud, as well as to modernize the front-end systems, such as digital banking services on mobile and internet, ATMs, etc. This fundamental change, as I understand it, allows much more powerful product development with a shorter time to market and the better ability to integrate with the outside world. Could you tell us a little bit more about the importance of this change and how you get this significant project done so successfully? I think a lot of banks probably want to, do the first and basic things first.
So first of all, Casey, I should confess that we started in the journey of rationalizing our backend technology as early as 2010. So between 2010 and 2013, we spent 4 years doing a cleanup, and we were able to come to a common core bank. We used to have 17 core banking platforms. We were able to rationalize it to one. We cleaned up our product processes. The reason I point out is that you need some down payment before you can embark on this substantive technology change. So let's park that aside for a minute. The second thing I should point out is many of the big tech firms also started with our kind of technology. People believe that all the Googles and Netflix of the world always started with cloud native technology. That's not true. If you look at all the companies which started before 2007 or 2008, they also had big data centers and IBM mainframes. It is only when Amazon created AWS that they started sowing the seeds of this profound technology revolution. It's actually quite well known that in 2007, Netflix had a very famous 3-day outage in New York. It's then that Amazon Web Services and Netflix worked to put Netflix on the path of this new technology infrastructure. When we started studying the tech firms, we realized that most of them had changed in a period that took 4 to 5 years. And this happened from 2007 onwards. You look at all of them, Google, Netflix, LinkedIn, they all started changing. It took 4 or 5 years to get the new tech stack. So our vision in 2014 was that we should be able to get substantive change in a 4-year period. And so by 2018, that was our target to be able to do that. And actually by 2018, we were able to do 97, 98% of what we'd set out to do. Now, the way you deal with it, though, is important. In the past, banks have always tried to do one massive project of decommissioning the core banking and doing a massive upgrade at one time. We thought that was kind of risky, and so we followed a different strategy. It was a threefold strategy of basically unpeeling the onion. We said any new technology that we develop, we will develop on the new stack, cloud native. Old technology, we will see the capabilities that we have that we can ring fence and essentially containerize. And we put them into containers. We were one of the first users of Kubernetes and so on to containerize the old technology and be able to therefore use it and build APIs on the back of that. And then there were some components which are deeply embedded into our core production system where we stripped out a module by module. And we took in each module and took it away. So as you know, in Hong Kong, we were able to complete. Hong Kong was our second last core banking. We finished all our other core bankings in the first couple of years. Hong Kong was our second last, where we turned off the switch a couple of years ago. In Singapore, we actually still haven't turned off the switch. A couple of our activities, our cards system, for example, is still mainframe. And so that will still take us a couple of more years to complete in terms of our application suite. But my advice to people is this: you've got to think about it in, like I said, peeling the onion, be granular, try to ring fence the new activities differently from how you strip down the old activities. You mentioned something about going on the cloud. As a matter of fact, we have already created our own virtual private cloud. So 99% of our activities are on our own VPC, not in the public cloud. We had some reservations at that time. But you can do that. But it does mean having the people, having the management team, and having an architectural discipline around the path you want to take. And then within that, giving people flexibility to operate.
Yeah, thank you. Well, I see that we have quite a number of interesting questions from the audience, but unfortunately, time is running out quickly. I couldn't resist asking you one more question. I mean, about how we do, what we do looking forward. I noticed, well, you mentioned a little bit earlier, and I noticed from an earlier speech of yours from YouTube that you think the time has come, a tipping point, so to speak, for a huge shift in the paradigm, when the power of blockchain and tokenization will change the fabric of the financial industry in the coming decade. And you also mentioned earlier on your investments in a few exchanges and platforms and so on. Can you, in a very simple way, tell us a little bit more about this very important shift in the financial industry paradigm and what we should really be thinking about?
So, Casey, you think about, I'm going to take it a step above the financial industry. I'm going to take it to all notion of value. Today's notion of value effectively relies on somebody sitting there and keeping a record. And it is a very hub and spoke arrangement. So you take housing. So if you own a house, how do we demonstrate that Casey owns this house? You only do that because there's a registrar of societies sitting somewhere who's keeping a record and saying, yes, this title and this house belongs to Casey. Similar is true for money. We know people have money because the bank is sitting in the middle and keeping track and saying, okay, you have so much in your account and XYZ has so much in their account. So the notion of value today is captured in hub and spoke arrangements with central entities which are record keepers. The power of a distributed ledger technology is that you no longer need those central keepers of records. And the minute you embrace that notion that you might not need central record keepers, that then starts calling into question the very fabric of the arrangements that we built. Do you need a stock exchange? Do you need a bank? Do you need a registrar society? Do you need anybody whose job is being a record keeper? If you can imagine a world where everybody is keeping all the records are immutable, the records are transparent, they can be shared among each other, then the whole idea of central hubs disappears. And that fundamentally causes you to rethink the nature and construct of the social arrangements and the economic arrangements that we built. That's why I think it's such a powerful idea. Now, what comes in the way of this getting scaled, it is how do you get enough people to share a common protocol and how do you get exponential use? So that is issue number one. Once you start getting that and more people trust this underlying system of record keeping, then you start eroding the power of the central record keepers. If you think about in its extreme, the notion of DeFi today, the distributed finance, is effectively that. People are saying we can trade with each other, we can exchange with each other, we don't need intermediaries in the middle. And therefore, whether it's in the payment space, or the wealth space, or the buying and selling space, we will just do it as a democratic population among each other without central distributors. Now, so the underlying technology, I think, is headed in that direction. Now, there's some caveats. The caveat number one is that as you go down this path, you start coming to one very, very important and intractable problem, which is what is the role of the nation state versus what is the role of underlying technology. If you believe that the nation state is still an important organizing principle and the nation state will not go away anytime soon, then you'll figure that that will be one big barrier to a technology-driven solution that lets everybody come on a common platform. This is particularly so in the nature of currency. Today, nation states control money supply, and this is a really important thing for them to control to hold the wheels of the economy. Whether they take interest rates up, whether they limit money supply, that's how they get economic growth. It's an important engine of monetary policy. I don't think nation states will be willing to give up this engine of monetary policy very willingly. So I think over the next decade, you will see this tension between technologies and consumers who want to leverage these technologies on democratic platforms and nation states who, from their organizing principle and democratic arrangements, want to retain control over some of the system. But you will find increasingly that while in the case of currency, this impinges on monetary policy, you will start finding that other areas where there is a much better alignment of interests. And so you will see that you won't see the same degree of tension. Also, in some cases, the nation state itself will take over this technology and try to use it as a means of gaining efficiency in the system. Central bank digital currencies are a case in point where central banks will say, guess what, we will just issue the digital currency ourselves. And if we do that, then we can actually create the distributed financial architecture. Even when you do that, of course, it's not straightforward because when you do that, then the central bank today uses the banking system to intermediate and create credit. Will the central bank take on the onus for creating credit? Highly unlikely. So I'm not suggesting, Casey, by any means that this is going to be a smooth journey. What I'm saying is the nature and the direction of travel is increasingly beginning to be apparent. And I think over the next decade, you're going to see some game-changing outcomes as a consequence of that.
Yeah, it's a subject that we could devote another hour at least. CBDC and all that tokenizations and so on. But unfortunately, time is running out. Thank you very much, Piyush. Well, DBS has been named not only the best digital bank of the world, it has been named the world's the Global Bank of the Year by The Banker, the best bank in the world by Global Finance, and the list goes on and on. Congratulations, Piyush, for all these significant achievements. It is great that we have the chance to listen to you today. Many thanks again for your generous sharing.
Not at all. Thank you. And thank you again one more time publicly for your contribution to our board over the years. Thanks very much.
Thank you. Have a good day.